1. Basic concepts of accounting. The basic concept of accounting are an important foundation that explains how financial information is recorded, processed, and reported systematically and consistently in order to provide an accurate picture of the financial condition of an entity. The main principles in this concept include several aspects such as business unity, which emphasizes the separation between personal and company finances so that reports reflect the company's performance purely, and the concept of business continuity, which assumes that the company will operate in the long term with no plans to cease its activities in the near future. In addition, the concept of accounting periods requires financial statements to be prepared periodically within a certain time frame, enabling comparison and evaluation of the company's performance over time. The basic concept of accrual is also an important part, stating that transactions must be recorded when they occur, not when cash is received or paid. The cost concept stipulates that the recording of assets is based on the initial cost of acquisition, not market value. Other principles, such as consistency in recording methods, the use of a stable monetary unit, and the measurement of money value, are also important foundations for ensuring that financial statements are reliable and easy to understand. 2. Definition of accounts. Account and accounting are special categories used to classify and record various financial transactions in a company. These accounts are divided into 5 main types, namely asset accounts, liability accounts, equity accounts, income accounts, and expense accounts. Asset accounts include all resources owned by the company that have economic value, both tangible, such as cash, inventory, and property, and intangible, such as patents or trademarks. Assets can be divided into current assets that are easily liquidated, such as cash and accounts receivable, and non-current assets, such as property and equipment owned for the long term. Liability accounts record all debts and obligations that the company owes to other parties that must be settled within a certain period, such as accounts payable and bank loans. Equity represents the owner's rights to the company's assets after deducting liabilities, often including paid-in capital and retained earnings that are not distributed. Revenue accounts record all receipts obtained from operational activities, such as sales of products or services. Meanwhile, expense accounts record all expenditures incurred by the company to run its operations, such as payroll, rent, and utilities. 3. Definition of normal account balance. In addition to these types of accounts, there are also profit and loss accounts that record the results of transactions that are not routine or outside the company's main activities, such as profits or losses from the sale of fixed assets. Other comprehensive income accounts record income or losses that are not reflected in the income statement, such as changes in the market value of financial assets. Each account has a normal balance that indicates the normal position of an account in the books. Asset and expense accounts usually have a normal balance on the debit side, because increases in these accounts are recorded on the debit side. Conversely, liability, equity, and income accounts usually have a normal balance on the credit side, because increases in these accounts are recorded on the credit side. This approach is important to ensure that the basic accounting equation, assets equals liabilities plus equity, is always maintained.